Sweden has some of the most successful investment companies in the world. This is Finance Lab Alpha. My name is Emma. Over long periods of time, many of them have beaten the stock market. Companies like Investor, Industrivärden, and Latour. This is not an accident. It is the result of a very specific business model. And in this video, I will explain why it works, where the returns actually come from, and most important, when it can fail. A Swedish investment company is not a fund. It is a company that owns other companies, often with large long-term ownership stakes. This difference is extremely important. A fund is a product. It has clients, it has inflows and outflows, and it is forced to react to market sentiment. An investment company has permanent capital. It does not face redemptions. It does not have to sell when markets fall. That alone changes behavior completely. It allows these companies to think in decades, not quarters. When people look at investment companies, they often think the return comes from picking stocks. That is only a small part of the story. In reality, returns come from 4 different sources. First, the underlying companies grow. Second, capital is allocated between businesses. Third, the valuation multiple changes over time. And fourth, the discount to net asset value changes. Understanding these 4 return drivers is the key to understanding this entire model. Permanent capital is the core advantage. It allows investment companies to behave rationally when others cannot. During crises, many investors are forced sellers. Funds face redemptions. Institutions face risk limits. Investment companies do not. They can do the opposite. They can increase ownership. Historically, this has been one of the main sources of long-term outperformance. An investment company is essentially a portfolio of shares. The value of that portfolio is called net asset value, or NAV. But the investment company itself trades as a stock on the market. And very often, it trades below the value of its assets. That is called a discount to NAV. This discount exists for many reasons. Some are rational, some are psychological. But over long periods, changes in this discount can have a huge impact on returns. The discount is not just a number, it is a measure of trust. Trust in management, trust in governance, trust in capital allocation. When confidence is high, discounts shrink. When confidence is low, discounts can stay wide for many years. This means that part of your return is not driven by companies. It is driven by how the market feels about the owner. Many investment companies also use leverage, not extreme leverage, but some. This increases returns in good times, and it increases pain in bad times. Leverage is never the reason for success, but it is often the reason for disaster when things go wrong. When you analyze an investment company, you should not start with the share price. You should start with 3 questions. First, do I trust the owners and management? Second, do I like the underlying portfolio? Third, am I being paid to wait through the discount? If the answer to all 3 is yes, then the model can work very well. Swedish investment companies work because they combine permanent capital, concentration, active ownership, and disciplined capital allocation. But the real driver of long-term returns is not financial engineering. It is decision quality and patience.